Hello, everybody, and welcome back to our one before final session of the ESG Investment Leaders North America 2022 Summit. Great to have you back with us. Thanks for joining. I'm joined here by Chris Cote, who's the lead for the ESG and climate research team at MSCI. Chris is going to be giving us his thoughts on the global transition to net zero, objectives, and strategic opportunities for investors. Good day to you, Chris. How are you?
Hi, Noel. I'm great. Thank you so much for having me.
Well, thank you very much for joining us. Well, I'm going to switch over now to the presentation screen, so you're underway.
Perfect.
And then,
Thanks. So, as introduced by Noel, I'm Chris Cote, and I lead the ESG and climate research team in the Americas at MSCI. And I'm here today to talk to you about climate change, but more specifically, net zero investing. What is it? What are its objectives? What levers do investors have at their disposal to get their portfolios to net zero? And I think most importantly, is there evidence that these levers actually work? But first, before we get into the portfolio construction and investing side of things, it's essential to understand where the real economy currently stands with regard to greenhouse gas emissions. How much time is left to stay within the emissions budget set within the Paris Agreement back in 2015, and how the impact of companies on climate in terms of the effect on expected temperature rise into the future is distributed across the economy. And we keep up on these data points at MSCI through a publication we have on a quarterly basis called the Net Zero Tracker. But to take a step back, as we know from the Intergovernmental Panel on Climate Change, the IPCC, our best chance at mitigating the worst effects of climate change is to reduce global emissions in a way that limits temperature rise to well below 2 degrees Celsius, ideally 1.5 degrees Celsius from pre-industrial levels. The lines in the chart at the right from the IPCC show the emissions reductions pathways that get the economy there. And just as important as the trajectory or the slope of the line itself is that actually the area under the curve of the line, that cumulative aspect of emissions is critical. And so you can think of the shape under the pathway, the cumulative emissions between now and say 2050 or 2070 as the remaining emissions budget, the budget that's left to eat up with the emissions that companies and people, our economy are emitting every day. For investors, net zero means aligning investments with the Paris aligned emission pathway, keeping financed emissions within this emissions budget. In our research at MSCI, we've looked at the emissions data associated with more than 9,000 publicly listed companies. These companies make up more than 99% of the equity market cap in investable markets. And one thing is clear, we're quickly running out of time to reach net zero. The red in the hourglass represents the 1.5 degree budget up top, while as the orange is the 2 degree budget. So the 2 degree budget is larger, but is still emptying as well. And as you can see here, there are fewer than 5 years left for the companies that we're looking at to reduce their emissions before they eat through or burn through their 1.5 degree budget. And as I mentioned with the orange part of the hourglass, it's a longer period. Instead of 5 years for a 2 degree warming scenario, it's closer to 20 years. But I want to make sure to highlight that if we miss this 1.5 degree window, it's not like we can just wait for the next bus or the next plane. Each tenth of a degree, each tiny bit has enormous consequences, potential consequences for the physical effects on the the climate. A look at the historical emissions data shows that based on past performance, which of course does not imply any future performance, there hasn't been any recent momentum toward a sharp turnaround. As we saw during COVID, or during the earliest days of COVIDs and the severe lockdowns in Europe and North America, emissions declined then, but they've since rebounded, right? And while we can use historical data to look at recent emissions of companies, can we also look forward? We know that more than 1,300 companies have set emission reduction targets since the Paris Agreement in 2015, in December 2015, right? So there are more and more companies setting targets. And can we use this information to tell us something about where they at least plan to be headed in the future? So at MSCI, we assess these targets, standardize them in terms of their comprehensiveness, the ambition of the target, how many scopes does it cover, what percentage of the company's total emissions footprint, including value chain emissions, direct emissions, does it cover? And we combine these with the company's current emissions, the size of the company in terms of revenues, and then our estimation of a fair share emissions budget for that company to estimate what we call the implied temperature rise of a company. What degree of temperature rise is a company's current and planned behavior aligned with? Is it 1 degree, 2 degrees, 7 or 10 degrees? This forward looking metric, which is designed to align with the recommendations of the Task Force on Climate Related Financial Disclosures, the TCFD, shows that the picture is only somewhat rosier looking forward. So, with those 9,000 plus companies, we see that on average, they are aligned with more like 3 degrees of temperature rise. And you might ask yourself, is 3 degrees really so bad? Sounds like a small number. But this could lead to 10 times the risk of extinction among endangered species, 10 times the risk of loss of biodiversity hotspots compared to the 1.5-degree scenario, and a significant rise in extreme weather events and coastal flooding. As the IPCC has made clear in its most recent reports, 1.5 degrees of temperature rise is bad enough as a scenario. Every tenth of a degree after that really matters for physical outcomes for the planet. So in the second chart here, you see that less than half of the companies that we assess are aligned with 2 degree Celsius budget, and fewer than 1 in 10 are aligned with a 1.5 degree budget. Digging a little deeper into the sector level data, perhaps unsurprisingly, many of the companies aligned with higher temperatures are in the most emissions intensive sectors: energy, materials, utilities. You see those three bars toward the top. These companies have high emissions today, and only a handful of them have indicated that they're serious about transitioning by setting comprehensive, ambitious decarbonization targets. Some have set plans, some have said this is how we're going to change our business operations going forward, but most still have not. It's also important to point out that no sector is perfectly aligned with 1.5 degree of temperature rise. Communication service and healthcare sectors, which we don't think of as particularly emissions intensive, based on the budgets that have been allocated to them, are still above, not by much, but are still above this 1.5 degree pathway on average. To see how a tool like this, the implied temperature rise metric, begins to give investors options to differentiate their capital allocations, thinking about tilting toward or away from not just higher emitters today, but companies that plan to transition in the future. We can take, for example, this set of coal producers. Most of them, perhaps intuitively, are aligned with 10 degrees, and this is where we cap the metric, right? So we cap it at 10 degrees, and they are sort of maxing out on it. This makes sense. They're producing a lot of coal, which is creating a lot of emissions. However, there are a couple of companies, most notably AGL Energy, which you see with the green small bar in the bottom left, that plan to significantly reduce their emissions. They have a comprehensive target. It covers more than 80% of their emissions. They have CapEx plans that signal an intent to shift the type of business that they're actually in away from coal. And if they follow through on their plans, which MSCI and others plan to track, then this causes them today to stand out among coal producers that don't have plans or maybe have less ambitious plans to decarbonize. So you can see here that even among coal producers, you have a number of companies that have that sort of 10-degree max temperature rise alignment. But then you have others in the orange that are in the 7 to 5 degree area, and then others that are in the yellow or green, right? That 2 to 3 degree to 1.7 degree, 1.4 degree alignment. So this differentiation begins to give investors potential options to consider. So with that background, and this understanding of where we as an economy, as sort of an investment focus, where that is, we can talk now about the potential objectives and the strategic approaches available to investors focused on net zero, right? Turning toward net zero investing. So at this point, I think we understand that net zero investing is keeping the financed emissions of a portfolio within an emissions budget, and also, of course, arriving at a state of net zero emissions in the future. And these are the two key points: reaching net zero emissions with the financed emissions, and also staying within the portfolio's allocated share of an emissions budget. And as we're seeing, and as we've heard today, investors are setting targets, maybe with the Net Zero Asset Owners Initiative or Alliance and the Net Zero Asset Managers Initiative, to think about decarbonizing their portfolios over time. What are the 2030 targets? What are the 2050 targets? What are the 2070 targets if necessary? And as we think about objectives, let's start with the assumption that the objective, much as set out with Net Zero Asset Owners Alliance, is to drive change in the real world, not just decarbonize a portfolio in isolation. In other words, to have a physical effect, not just a paper effect. So a group of colleagues and I have looked at this, and the first question we wanted to ask was, does net zero investing help reduce emissions in the real economy? First, we took a conceptual approach thinking through this problem. And of course, it depends on the approach taken by the investor, by the portfolio manager. Conceptually, it's not hard to imagine dislocating a portfolio from the broader market, concentrating investments in low emission sectors such as healthcare and tech, and abandoning high emission sectors like energy, utilities, materials, as we saw before. In this divergent scenario, a portfolio could face other risks like crowding and concentration risks, but it's relatively straightforward to achieve net zero emissions. You simply focus all of your investments on the lowest emitting companies, voila. Of course, for a large universal owner, manager, this may not be possible. There are other reasons why it may not be possible depending on a mandate, and it would likely do little to achieve the broader underlying objectives of driving the economy toward net zero as well. And clearly, this type of approach isn't exactly in the spirit of the Paris Agreement, right, which is to align finance with an economic drive to reduce emissions. Instead, as we see on the right, investors could drive emissions down in the real world by identifying companies with a strategy to transition, using the levers at their disposal to help companies stay on their emissions reduction pathway, and achieving convergence. So, in this convergence scenario, investors decarbonize their portfolios, but do so in a way that brings the broader market with them. And in a paper that we have that looks into this in detail, we also suggest that this could this decarbonization of the broader market improves the market beta by reducing systemic risk in addition to just the idiosyncratic risks that the portfolio may hold. But conceptually, that's nice. But what levers do investors actually have to pull? And is there evidence that these levers actually work? So the four broad levers that we identified probably don't come as a surprise to you. First, starting in the top left here, investors can improve access to and the cost of capital for emissions improvers or decarbonization leaders by identifying and financing companies on a sufficiently ambitious decarbonization pathway, right? Those companies that have strong targets, that plan to decarbonize, that have a strategy to get there. Or by financing companies that could help others to decarbonize. These would be solutions providers, maybe wind or solar manufacturers, clean hydrogen providers, companies that are focused on providing energy efficiency solutions. Um, Helping to scale this deployment or bring down the costs of hard to abate technologies could also be one approach. And to look at the evidence for this, we compared, in a quintile analysis, we compared the most emissions intensive companies to the least emissions intensive companies. And we did find evidence, historical evidence, recent historical evidence, to support improving costs of equity and price to book ratios, improving price to book ratios for these least intensive emitters after controlling for other factors, of course. Second, investors can influence companies' emissions targets through engagement, right? So they can be advocating either in private meetings or through proxy voting, as we're seeing beginning to emerge basically now, uh, that they can influence company behavior. Studying this, we found examples where this has worked in select instances, but there was a lack of a broader trend so far. Our working hypothesis is that more coordinated action and more scale would create more change, right? Driving more companies to adapt strategies in the first place and to strengthen them over time. And we'll be looking for further evidence for this during this year's proxy season. Third, moving down to the bottom right, if extensive engagement around transition fails, investors can allocate capital away from companies. This is the flip side of financing leaders, right? Either divesting from or tilting away from, rebalancing away from climate laggards. Conversely, to the financing leaders scenario, hurting their cost of capital and access to capital. And finally, policy and regulation, which is a little bit different than the more portfolio based approach, but policy and regulation will undoubtedly play a large role in the transition of the economy and society to net zero, right? The policy and regulatory environment undoubtedly matters. Institutional investors can choose to advocate for policies, for example, a carbon pricing mechanism that help level the playing field between the highest emitters and the least intensive emitters, whether through a carbon tax directly or some other type of standard or emissions trading scheme. These programs, when the price is right or the regulation is sufficiently well targeted, can drive change rapidly, can cause things to decarbonize, companies to decarbonize rapidly. We saw an example of this, which we highlight in our paper, in the coal to gas transition in the United States in the early 2010s, where regulations by the US government focused on uh, toxic emissions, mercury from coal, led to a large shift away from coal just as the gas boom was happening. Uh, and this is happening all around the world again with a shift toward renewables. So, to sum up, for all of these levers, we found that there's evidence that they do indeed work, but that so far investors haven't used them at sufficient scale to put most companies on a net zero pathway. So, they're working, but they haven't been used enough. So, given that companies haven't reduced their emissions enough and only half are aligned with the 2-degree or better pathway, we now ask what practical steps can investors take for portfolio construction? And to start, we looked at two, frankly, stylized approaches to begin to think through this problem. The first approach is straightforward. Over time, you rebalance away as the portfolio, you rebalance the portfolio away from more intense emitters toward less intense emitters. Basically, you throw out the dirtier companies and you focus more and more on the cleaner ones. Makes sense. So this approach has the advantage of, making sense, being relatively simple to implement. It's intuitive. It relies less on models, estimations, and provides an incentive for higher emitters to reduce their emissions. Right? They want to continue to meet those portfolio investment criteria. However, the approach is imperfect. The historical emissions data lag, right? Often they come out a year or even 2 years later. So you're not capturing the current trends of the company. The approach doesn't take into account any forward looking data or plans. So the company historically could have been dirty, but now is saying we have a plan to change. And this approach doesn't take that into account. And it could risk leading to concentrated portfolios depending on the state of the actual decarbonization of the real economy. A second approach could be tilting toward emissions improvers or companies that are signaling that they are transitioning. Standardizing heterogeneous target data, and it is very heterogeneous, companies are disclosing their targets in many different ways currently, can be quite difficult. And understanding how this could affect a company's trajectory in the future does require modeling, estimation, and other sophisticated work. But the advantages are that it is forward looking. It does capture that data of what companies say and plan to do, not just what they've done historically. It rewards improvers, which is an important part of actually shifting the real economy. Done correctly, this approach could help drive that convergence scenario, which I highlighted toward earlier in the presentation. Of course, a combination of the two approaches is also possible, using both the forward-looking estimates, but as needed, tilting away from higher emitters to reach the portfolio's emissions reduction targets, right? So you focus on maybe the implied temperature rise metric for companies, what they plan to do in the future, translating that into some statistical metric, but as necessary, tilting away from the dirtier companies or maybe the companies where engagement hasn't worked. So this is more complex to implement, but maybe more realistic in the short term given the availability of data. To sum up this research, conceptual and empirical evidence suggests that investors can drive the economy's decarbonization, either through shifting capital away from laggards toward leaders, using voting and engagement to target laggards and move companies from that laggard toward that leader category, and also uh, taking a step back, supporting climate policies to tackle emission-free riding, right, where more emissions-intensive companies are producing this externality that's not being priced into the economy anywhere, or at least not everywhere. However, we see that this hasn't happened sufficiently at scale to make the change necessary to get onto a net zero path. Finally, I'd like to conclude by pointing out two rather obvious points. One, that the road to net zero has unexpected turns. And two, that of course climate change and the efforts to mitigate it, both from investors and from the rest of the world, are not happening in a vacuum. So the war in Ukraine has had significant impact on current and likely future energy policies and the state of energy markets, especially in Europe, but also around the entire world. So as a team of researchers, we recently asked, what consequences may any shifts in policy have for climate risk? Or will a delay in transition add to the costs of decarbonization? So to go back to this sort of schematic that I showed earlier, we attempted a preliminary answer, understanding that there are many significant uncertainties involved in this type of analysis, but we sketched out one pathway that the war and Europe's response may change the region's decarbonization pathway. For example, in one scenario, a shift away from Russian gas, which Europe is trying to implement, could increase Europe's consumption of coal in the short term. They search for a more stable energy supply. They cut off Russia's gas that they import, and turn to coal in the short term. This would, of course, lead to increased emissions. However, Europe's at the same time been quite firm in its statement. The political leaders have been quite firm in saying that they will remain on track for their 2030 climate goals. So if you put these together, to achieve these goals on time, Europe would have to redouble its efforts after the initial coal burning period, let's say for the next 5 years, to stay within that entire emissions budget which they had previously set for themselves. So we used scenario analysis where the main drivers of the transition, these are the network for greening the financial system scenarios, where the main driver of transition is carbon pricing, and our climate risk models that we produce in our climate risk center to understand what a delayed but then accelerated transition, as you see in the darker line here, would mean for companies in Europe and the cost of their transition as expressed through a higher carbon price implemented around, say, 2027, 2030. And what we found in this delayed action scenario, which we acknowledge is not a perfect overlay of what could be happening in the real world, but gives us an approximation, to begin to build intuition, is that costs increased a lot in delaying action, moving to coal in the short term, and then even though you accelerate emissions reductions later, energy and materials companies were worse off. Utilities companies were more mixed, in part because the opportunities associated with renewable energy and other clean tech helped make up for the higher costs that they were paying in the long run. And it's also worth noting that, as toward the top of the chart, that this delayed action scenario, the costs of transition for even much less affected sectors, IT, real estate, healthcare, is still increased by multiples over a more gradual decarbonization scenario. At the same time, I want to be clear that this chart is not showing any risks from the physical effects of climate change, which would add on top of this. The longer delayed, as I mentioned before, the more scientists expect the physical risks to become more extreme. So to wrap up, the cost minimizing pathway to reduce the financial risks associated with climate change, as we see here in the case study on Europe, is a fast and gradual pathway undertaken without delay. That's not where the world has been headed recently, as we saw in the emissions data I showed before. But investors do have the levers needed to help drive net zero convergence between portfolios and the real economy. They just need to use these levers more and at scale. Thank you. I can't hear you, Noel.
Thank you very much for that, Chris. Yes, sorry, just unmuted myself. Thank you very much for that insightful presentation. Really useful. So a question for you, Chris, from watching that. In terms of regulations that you think could be very useful to empower asset managers and asset owners to see the transition happen quicker, what kind of regulations do you think could be useful? What do you see coming down the line as well?
Well, one thing we see in the GFANZ initiatives, right, the Glasgow Financial Alliances for Net Zero, is advocacy for carbon pricing mechanisms more generally. And I think one thing that we've learned from watching this sort of iterative process of policy making is that different things seem to work better in different places. So the EU has had their emission trading scheme for a while, and it has its effects. California has its own emissions trading scheme linked up with the low carbon fuel standard. And in the US more broadly, a carbon tax has been more difficult to implement politically. So I think getting any type of carbon pricing mechanism is the most important thing, whether it's through a standard or a tax or an emission trading scheme, a cap and trade scheme. I think is something that's better left to the sort of the political reality of the situation, because getting one into effect is maybe more important than what exact type it is.
Okay. And do you see, in terms of a global coordinated effort to achieve net zero, do you think that the recent geopolitical conflicts have somewhat slowed down that conversation? Do you think we could get back onto an even keel in that respect?
It does seem like we're definitely at an inflection point, right, where you have much more interest in resurgence in interest in fossil fuels, with prices up, returns high, uh, you know, free cash flow being returned to shareholders. On the flip side, we see, as I just showed in this analysis, that this sort of short-term view could lead to actually much higher costs in the long term. And so there's a balance to be had from investors thinking about their fiduciary duties, but then also, over what period do you think about those? So I think there's a lot to consider here, but I do think that at the very least, that this geopolitical moment has put pressure on what the drivers of these transitions are and how committed investors and political leaders and just society more broadly are to them. It's more difficult to decarbonize today, but at the same time, we are seeing a redoubling of commitments from the US, from the EU, from China, from others to focus on those 2030 goals and stay committed to them.
Right, thank you very much. In regards to new technologies that are coming down the line, there has been a lot of talk about the prospects of wind, prospects of solar, the ability for these types of technologies to take a lead. Do you see any new green technologies coming to the fore that you think investors should be aware of, that's going to, again, help the transition to net zero?
Yeah, so one thing that I think was important and highlighted in this third and most recent report by the IPCC, but then also has been highlighted, more generally, is that we have the technologies that we need to go very far, very fast on decarbonization. Wind and solar, just decarbonizing the electricity system is going to take us a large way there. After that, you get into some of the sort of heavier duty stuff that hard to abate sectors. I think clean hydrogen could play a role in there. It's not going to be, in my personal opinion, maybe the be all end all of decarbonization. That will be driven by wind, solar, and other clean energy technologies. But you do have clean hydrogen and others getting into the more difficult to abate sectors. And of course, there's energy efficiency, which is critical as well.
Wonderful, excellent. Well, Chris, thank you very much for your insights. Greatly appreciated. To our audience, that brings us to the end of this session. If you'd like to click on back to timeline, then that'll take you back to the main agenda, where you can join us for Gina Sanchez's final presentation for this event. But Chris, thank you very much for your time today.
Many thanks, Noel. Great to be here.